Today, we're diving into the world of passive income investing and comparing two high-quality dividend growth ETFs, Schwab US Dividend Equity ETF, ticker symbol, SCHD, and the Vanguard Dividend Appreciation ETF, ticker symbol, VIG. So if you're looking to build wealth through dividend investing and want to make an informed choice, you've come to the right place. Let's get started. Passive income investing is like the holy grail of retirement planning. It's all about focusing on the cash flow from investments and ignoring the market's ups and downs. This approach simplifies things and helps you stay calm when others are panicking. SCHD is an exchange-traded fund designed to provide investors with exposure to high-quality U.S. companies that have a strong history of paying dividends. This ETF aims to track the performance of the Dow Jones U.S. Dividend 100 Index, and focuses on companies that consistently pay dividends and have the potential for future dividend growth. SCHD is known for its reliability in delivering consistent income to investors. On the other hand, we have VIG, which is another exchange-traded fund, and it's managed by Vanguard, one of the largest and most reputable investment management companies in the world. VIG's primary goal is to track the performance of the Nasdaq US Dividend Achievers Select Index. This ETF emphasizes companies with a history of increasing their dividends over time, making it an attractive choice for those seeking both dividend income and potential for dividend growth. First up, let's look at their total return track records. Over the past decade, both SCHD and VIG have delivered exceptional performance, closely mirroring each other. However, SCHD has slightly outpaced VIG in terms of total returns. It's worth noting that both have incredibly low expense ratios at 0.06%, so SCHD's edge comes from its underlying holdings performance. Now let's take a look at their dividend growth track record. In order to understand which is better, one metric can really help us achieve that. That is the CAGR. CAGR stands for Compound Annual Growth Rate. It's a financial metric used to measure the annualized growth rate of an investment or asset over a specified period of time. CAGR takes into account the effect of compounding, which means it considers how an investment grows or declines on an annual basis, assuming that the returns are reinvested. In simpler terms, CAGR helps you understand how an investment or asset has grown on an average annual basis, smoothing out fluctuations and providing a single, consistent growth rate that makes it easier to compare different investments or assets over time. It's a valuable tool for assessing the long-term performance of investments. When it comes to dividend growth, SCHD has been the star player. It posted an impressive 11.32% CAGR over the past decade, leaving VIG behind at 7.88%. Over the last 5 years, SCHD continued to shine with a 13.92% CAGR compared to VIG's 9.89%. Although VIG has improved in recent years, SCHD still holds the crown as the superior dividend grower. Let's dive into their portfolio composition. VIG has more exposure to technology stocks, while SCHD leans more towards energy and industrials. This contributes to SCHD's higher dividend yield since energy and industrials generally offer higher yields than tech stocks. In terms of diversification, VIG has more individual holdings, 317, compared to SCHD's 104 holdings. However, SCHD's 104 holdings still provide adequate diversification. Looking at their top 10 positions, SCHD is more concentrated, but when considering the total number of positions, VIG is relatively less concentrated. It's worth noting that VIG has significant exposure to mega-cap tech stocks like Microsoft and Apple, which make up a substantial part of its portfolio. This is why VIG has a lower yield compared to SCHD, despite being exposed to technology. Next, let's talk dividends, my favorite part in any video. SCHD boasts a trailing 12-month dividend yield of 3.49%, while VIG lags behind at 1.90%. With its higher yield and strong dividend growth track record, SCHD is the clear winner in the dividend department. This also explains why it has generated better long-term total returns. Both SCHD and VIG are solid dividend growth ETFs. However, SCHD appears to have the edge with its superior total return and dividend growth track record, higher dividend yield, and a more defensive approach in its portfolio. If you're seeking an all-in-one exposure to tech giants and dividend growth, VIG might be your choice. But, if you want a fund that combines attractive passive income, long-term dividend growth, and total return potential, SCHD is the clear winner. Remember, these are just some factors to consider, and you should always do your own due diligence before making investment decisions. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more beginner-friendly investment content, and as always, happy investing.